Let's get across the market open now. Kyle Rodder joining us from Capital.com. Kyle, welcome back to you. Geopolitics continue to dominate, of course, with news out of the Middle East that both the US and Iran have at least agreed to halt hostilities with the prospect potentially of some sort of brokered peace. It is something we've heard before, but that's obviously, unless stops the rise in the oil price at least.
Yeah, and a big gap at the open this morning as well. So down sort of 6 or 7% in the first throes of things, and we'll sort of digest whether that can last throughout the session. But strikes have stopped over the last couple of days. The reportage around why that's the case has been a little bit mixed. Axios is suggesting that it might be a bit of a more strategic decision, try and get the Iranians back to the table, and sort of the belief that perhaps such a heavy-handed approach to negotiating mightn't be having the desired effect in terms of at least getting the Strait of Hormuz reopened. Then there's others sort of suggesting that this might be sort of a more short-term resource-driven decision by the United States, that there's a bit of degradation going on in air defense systems, and that it's trying to preserve those and ceasing strikes and looking to kind of de-escalate things as a result. But what can be said is that the oil price has dropped significantly on the fact that strikes have discontinued, that there's hopes that there might be some kind of ceasefire agreed to, even if it's something only short term, that kind of 10-day agreement that had been mooted last week. It remains fairly uncertain, fairly unclear, but the initial reaction in the markets is effectively relief, a big drop in the oil price, and it sort of sets us up as far as risk assets go for a slightly more positive start to the week. Of course, a week that's going to be pretty jam-packed when it comes to event risk.
Indeed. In fact, look, we've got the Fed decision. I'll get to that in a moment. But obviously, in the midst of earnings season too, over that unease, I guess we're seeing in relation to the spending, particularly from the hyperscalers, and a number of them are reporting this week.
Yeah, 4 of the 7 will report. Obviously, we had 2 last week, and it's kind of an interesting matter of whether the narrative reflects reality or not, I think, because of course everything that we've been talking about over the last couple of days has been, the likes of Alphabet and Tesla selling off really because of the increase in capital expenditure going forward for artificial intelligence, and even offsetting the instance of Alphabet, some really strong top and bottom line results. The flip side of that, though, is if you zoom out and you look at the S&P 500 in aggregate and also the tech sector specifically, the expectation now is for nothing short of an extraordinary earnings season, somewhere around 38% earnings growth for the period, revisions higher for the quarter ahead, which will be Q3, and valuations now that look historically, at least if you look over a sort of 5-year time frame, rather attractive. So on the one hand, you have this fear about capital expenditure and perhaps return on investment going forward when it comes to artificial intelligence. But then you've got these really, really strong results that sort of beg the question, is this sort of more narrative? Perhaps, the price actions being a little bit driven a little bit more by geopolitical risk and interest rate uncertainty, and the CAPEX story is just a convenient narrative to latch onto for now. And the market is, effectively will launch in the if we start to see geopolitical risk and interest rate uncertainty diminish, or whether, again, there is something fundamental here when it comes to the capital expenditure story, and such is the weight of those fears that it's offsetting what has been, like I said, a remarkably strong earnings season. But we'll get four of those magnificent 7 companies this week: Apple, Alphabet, Microsoft, and Meta. Sorry, not Alphabet, Amazon. And that will give us a little bit more color about whether, again, companies can continue to deliver these exceptional results. And again, it can't be sort of understated how exceptional they have been, and whether the markets look past that because of what's likely to be still, this increase in capital expenditure, at least from some of these hyperscaler names that are already pouring so much money into the space.
Now, Kyle, the other risk you mentioned this week is obviously the Fed meeting with the prospect. I mean, it's regarded as a very live meeting, and given what we've heard, particularly from Kevin Warsh, maintaining a fairly hawkish bias at this point.
Yes, and the markets are more or less implying that, like you said, it's a live meeting. And although we've seen the odds come down just a little bit this morning as far as the rates curve goes because of this drop in the oil price, which is obviously feeding into this expectation the Fed might be hiking at some point in the future, or at least the oil price is a contributing factor to that. there's still a sort of 35% implied probability that we'll get a rate hike this week from the Fed. Certainly the markets are pricing in that there will be a move more than likely by the end of the year. The issue is, of course, is that you've got the first risk here, or first theme, which is just the decision itself. The next part is obviously what the Fed will actually say or maybe won't say, given Walsh's reticence to give any sort of forward guidance and a real lack of desire to give any sort of view on monetary policy other than what's expressed by the committee at the particular meeting. And of course, at this decision as well, we don't have an updated summary of economic projections that we can at least get a view on what other Fed officials or FOMC voting members as well were kind of thinking about, talking about when it comes to considering policy and again, what could come from policy in the path forward. So it's a very live meeting, again, because the markets are still kind of filling out what kind of Fed head Kevin Walsh is going to be. There is that potential that even if we do get a hold, the uncertainty itself about where policy could head next could continue to add volatility into the markets. Needless to say, when you get that sort of event on the same day as that we're going to get a couple of Magnificent Seven names and off the back of a couple of Magnificent Seven results earlier in the week, the markets are kind of entering the week in a bit of trepidation. It's probably one of the reasons why we have seen equities on Wall Street come off the way that they have in the last couple of sessions, really as we de-risk for Mag 7 earnings and then sort of a fairly mercurial wash that the markets are still trying to work out.
Now, Kyle, locally, very much a focus on equities ahead of our own reporting season gets underway next week, of course, but more immediately, a quarterly read on inflation coming up this week ahead of the next RBA meeting.
Yeah, and after last week's really strong labour market data, there is a sense that, well, the RBA may have to continue to weight its price stability mandate a little bit higher than its employment mandate. And that if we do see a slightly spicy inflation print this week, that it might really drive that kind of impetus for a further rate hike from the RBA. At the moment, if you look at the rates futures curve, you've got markets pricing in roughly an 80% chance that there'll be another hike in this cycle, albeit next year. But obviously, we've got inflation still above target, arguably an unemployment rate that is above any sort of level of notional full employment. And the risk that some of these supply side factors in the economy, which is, keeping the proverbial, I guess you could say, speed limit of the economy, really kind of encouraging these sort of inflationary pressures to kind of build. So it will be a sort of a critical release. And obviously we've seen the ASX 200 more or less trade sideways for almost months now and really kind of underperform. If there are these continued upside risks to interest rates, it's clearly going to be something that kind of constrains that upside, continues to compress valuations, and really raises the prospect that, the economy is going to be in a fairly lukewarm state. Equity markets going to be in a fairly lukewarm state as we try and digest, effectively, the path forward for interest rates and to what extent the RBA can get inflation back under control.